Okay, let's talk about bond valuation. Spend a little bit of time talking about an application of some of the techniques we've been talking about with time value. We'll obviously get into risk a little bit later as far as a final capstone, if you will, of the valuation piece or the applications process of this particular of this course. Most of this terminology you should be very familiar with. Obviously, you know there's a piece of paper, there's a certificate that identifies the bond, has all the characteristics of the bond listed on there. You know that bond is debt, so it has a maturity date. There's a term remaining, obviously, when it's initially stated out. Most debt has 20 to 30 years of life. The term remaining then obviously is 5 years down the road. Then it has 15 to 25 years. The coupon is obviously very important. That's the interest rate that you actually get paid on a monthly basis, on a well, it's actually semi-annually for the for a bond. Most of our examples, we're going to assume that the coupon payments are just once a year. It just makes the math a little bit easier to understand what's going on. So obviously this will all be divided by 1. So essentially the coupon is just the rate that's stated on the certificate multiplied by the face value. And for corporate debt, the face value is always in $1,000. In fact, for almost all debt, it's in $1,000 increments. Don't know how I did it, but I ended up with 2 slides exactly the same. Zero coupon bond is a bond that doesn't pay any interest. It all sells at what we refer to as selling at a discount. That is, it sells at less than its par value. Treasury bills, by definition, are discount instruments. They don't pay they don't pay debt until they mature, but they're very short term. So they're only 30, 60, 90 days. Sometimes you could find a 180-day treasury bill. So you pay a price today, and then in 90 days you receive the value of whatever the treasury bill is. One of the things that is possible, though, is it is possible for individuals, to buy long-term debt and actually get zero coupon for it. So brokerage houses can take treasury securities and they break them down into 2 pieces. They can break them down into a zero coupon bond piece and then a coupon piece. And of course, since these both come from treasury securities, the income that you earn from them, they're both risk-free. So very low returns, but at the same time, it's something that's created by a brokerage house. So if you want long-term and you don't want to worry about interest rates, or you don't need that type of thing, maybe you want to you would want to invest in one of these brokerage house creations. I think sometimes refer to them as tigers and cats, CATS. I'm not exactly sure what the acronym stands for, but that seems like what strikes in my head is what they're referred to. So so let's kind of continue on. You have a 1-year bond, right? It's going to mature. It's going to have $100,000 face value. It currently sells at $96,000 odd. So this obviously is how the cash flow would work. You pay $96,000 odd today. You get $100,000 at the end of the year. Pays zero interest. So this is a zero coupon bond. So let's say we have the following types of zero coupon bonds that are selling at prices. They're all selling at less than $100. Well, how do I know that? $98, the 98 here, since its par value is 100, these are all selling at less than $100, so they're all selling at a discount. So what return would you get on this? Well, it's actually kind of easy to calculate the return. You just take the ending price, the value at the end, the $100 par, divided by the price. In this case, the very first one has a 2% yield to maturity. The second one is 2.5, then 3, then 3.5. So again, oops, I'm sorry, I went to push the wrong button. Just take this amount, divide it into 100, minus 1, ultimately gives you the yield. It's also something we talked about a little bit earlier, something called the holding period return. You can calculate it obviously that way as well. What's the risk-free interest rate that we could talk about? Well, we've talked about this conceptually in a couple of the last chapters. But if you go to the newspaper and you look up and you see what a treasury security is selling for, what is its yield that you would receive if you purchased it? That's what we refer to as the spot interest rate. A zero coupon yield curve then is just a plot of the risk-free zero coupon bond components of the treasury securities. Now we typically have to break these down because most long-term debt of the government, it all pays interest. So we have to take those coupons back out or back them out to get the zero coupon yield curve. So we talked obviously about coupon bonds. They pay face value at maturity. They pay regular coupons. Treasury notes are United States Treasury coupon securities, and they have maturities from 1 to 10 years. Treasury bonds, on the other hand, are 10 to 30 years. So that's the structure of the debt at the United States government, and quite frankly also at the corporate level with respect to just coupon bonds. So the U.S. Treasury just issued a 10-year $1,000 bond, has a 4% coupon, and it has a semi-annual coupon payment. What cash flows do you get if you hold this bond to maturity? So let's think about this. You buy it today, whatever the price is that you buy it today, and you get 4% per year, but it's paid semi-annually. So you're going to get 4% divided by 2. You get 2% every 6 months. So for the next 10 years, you'd get 20 payments of $20. And then at the very end, at that 20th payment, when you receive that 10 years from now, you also would get the $1,000 cash flow. What's the primary principle behind investing? Well, we need to identify what the value of the asset is. So that's a calculation. It's the present value of the expected future cash flows of the asset. For a bond, therefore, we need to have what are the coupon payments and what's the par value. The nice thing about bonds is we know exactly what these are. You know exactly what the coupon is. You know exactly what the maturity value is. You also know exactly when they're going to come. So we have a very good picture of a timeline, if you will, of when these cash flows ultimately will come to us. So the only thing we have to do is find the present value of that. Well, to find the present value, we need to understand something about risk. We need to have an idea of what the required return is on the asset, on the investment. We'll talk about that in a couple minutes. So in the meantime, let's just assume that we know what that number is, and we'll talk about that here in a couple more slides. One thing we have to realize, though, that interest rates and values of assets are inversely related. So as interest rates go up, bond values go down. And this is true of all assets. As the required rate of return of an asset increases, its value decreases. Yield to maturity is that interest rate that ultimately equates the cash that you're going to pay to buy the asset with the present value of the cash flow. And that's really not very enticing on a God, I need to know that kind of information. But here's a better definition for it. It's the rate of return that you earn if you buy the bond at the current price and you hold it to maturity. So it is the solution to a time value question. So the yield to maturity on a bond that's selling at par value will always be exactly equal to its coupon interest rate. The challenge is that over time, because interest rates in the economy change, the price of the assets change. Because sometimes companies become more or less risky, we change our required returns. Likewise, the price changes. So bond prices will move above and beyond, above and below the par value. So very seldom will the yield to maturity be exactly equal to what the coupon interest is. Our basic investment rule then says if the value of an asset, if what it's worth, is greater than or equal to its current market price, you'd want to buy it. And this is just a simple cost-benefit question. If you think you're going to get more than what you have to pay to buy for it, you would be willing to buy it. Another way to look at this, and quite frankly I think people are a little bit more comfortable with looking at percentages, is if the expected return on the investment, that is if its yield to maturity, is greater than or equal to what you require, you would buy it. And in this required return contains inflation, but it also contains the riskiness of the asset. So we have these two basic rules, and they always will agree with each other. They'll never be in conflict with each other. So let's look at a valuation example. And again, if we go to our time value or our spreadsheet, I'm sorry, I want to bring the spreadsheet up. Here's the bond valuation tab in the spreadsheet. Of course, we can enter in here the data that we want, right? It's 1,005, 5%. That said 10% with 8 years. Let's kind of go back and see what that is. Actually, it's 8 years, 8%, 10 years, 8%, 10 years. And we have here that the price is $825. So as you can see here, the value of this asset, as it says over here, is $798.70. So if you had to buy this for $825, would you buy it if you thought it was worth $798? Hopefully you know the answer there is obviously no. Another way to look at this, a little bit quicker, you don't have to think quite so hard. If you buy this, you're going to get it 7.5%, but the required rate of return was 8%. So you're not getting what you want, so you wouldn't want to purchase this asset. What if this bond, this is a zero coupon bond, what if it was selling for $450, right? Would you pay $450 to get something that you thought was worth $463? And of course you would. The required return's 8%, and if you actually paid the $450, you would earn 8.3. So in this case, this bond has more value, more benefit than what it costs to buy, and it's going to give you a higher rate of return than you want based on the assumptions that we have about risk. So again, here's a semi-annual bond. It's $1,000 par value.